But I think Maneesh Dangi is back with us. Maneesh, we snapped the line with you. Why don't you go ahead and make your point on what we're seeing in the market and the bond markets today?
No, I'm so sorry, it got disconnected. So the point I was making is that the first phase of reflation trade is sort of coming to an end. And this is sort of a phase when economy is in a bad condition, central bankers are trying to douse fire, keeping interest rates suppressed, flooding the money, flooding sort of economy with a lot of money. And so which is, when most of the bottom-up investors, look at markets with shock and awe that, why would markets do so well when economic conditions are bad? Now, that phase is starting to get over. And now what we're beginning to have is a new sort of a tug of war, I would say, between real economy and real rates. Economy is actually recovered, but perversely this begins to sort of take real rates higher. And which is what has happened in last couple of weeks across the world, including in US. Bond yields have actually trended higher, but they've been trending higher for the last few months. What's unique, of course, in last couple of weeks is that now not just the inflation expectations are rising, but also real rates are rising, which is the difference between nominal rates and break-even inflation or inflation expectation. And that's an enemy of equity or any other, long-term asset classes. And which is why I think while eventually I think equities would still do well, but you sort of have a small window here for the next couple of weeks or perhaps months where, there will be a struggle between real economy and real rates.
Maneesh, so what's the sense that you're getting, given the fact that you were talking about that first phase of reflationary trend coming to an end? What is it in terms of expectations on the interest rate front as well that you're expecting, because you are of the view that we are seeing some sort of a recovery emerging in the economy?
Well, absolutely. We've discussed with you folks, many times over the last 10, 11 months, and, this V-shaped recovery that we've argued many times with our investors and with some of you has actually played out. And as I said, perversely, this is what is beginning to hurt stocks in near term. Now, my long-term expectations sort of remain same. There is no great scarring because of COVID. Economy would recover, would continue to recover. And we as a country and world at large would perhaps see one of the best growth over the next 1 or 2 years. And so which arguably from a purely fundamental standpoint looks super good for asset classes like equities. But in near term, as I said, what's beginning to happen is that interest rates are rising. And again, equities and any other asset class, the cash flows have to be discounted. And particularly when real rates actually begin to rise, there are two ways to sort of look at it. It is possible that over the next few weeks, there will be a point at which, Fed, ECB or RBI would come and say that enough is enough and, the interest rate shouldn't rise and the financial repression would be practiced again. The rates would actually then begin to pause and unwind. And that is when perhaps, equity macro would begin to open up again. So in very, very near term, I would say for next few weeks and months, perhaps there is a little bit of a struggle because while economy recovers, but markets are spooked that if real rates continue to rise, then the discount factors would actually stay elevated. And so to that extent, this popular narrative for last few years of growth stocks, because they thrive in an environment where real rates are super low, I think that would get questioned. So it's a different narrative, and perhaps we will have to deal with it, as it sort of unfolds in front of us.
Right. Fair enough. So just wanted to get in your view, just if you could reiterate what the outlook is when it comes to the overall fundamentals of our economy, given that you're pretty optimistic about the economic growth. Where is it, Maneesh, that you expect that those pain points or the challenges could potentially emerge for us? What do you believe, that could be that factor that would lead to a decisive turnaround in the general undertone or trajectory of the markets?
See, there are two things. I think economy would do wonderfully well. You've seen analysts upgrading their forecast. We've argued about that India would actually do reasonably well even in FY21, and I think most, including RBI, are sort of coming around to accept that growth is not as bad as they expected it to be. More importantly, it's very likely that in FY22, which is next financial year, we would perhaps grow at 13-14% and even higher. You've seen a lot of these multilateral firms and organizations coming and upgrading their forecast for FY22. More importantly, phenomenal reforms are being undertaken by India, and I think the trajectory is set that India would do very, very well for next couple of years. So I actually, as I said, the economy is very likely to do very well, not just India, but across the world. But again, your question and, the fact that Nicholas insisted that I come and talk, the question we are not sort of dealing with today is economic recovery. It's doing very well. And perhaps it's one of the reasons of this perverse reaction by market today, because when economy does very well, what begins to happen is that markets begin to reprice real rates. And when they begin to reprice real rates at higher and higher level, at some point in time, markets, and particularly equity markets, begin to worry whether in some future markets, mortgages, equities would be able to adjust well with these high or elevated real rates. So that's the adjustment process right now. And which is why, sort of going back to the original point, that the reflation rate's first part is getting over. I am for once not telling that, this is it. It's very likely that from here on, the recovery and the real economic traction would actually take on the real yield. Because remember, in the past, for last many years, higher yields have actually coincided with, buoyant equity markets. But intermittently, when you are actually phasing out from doldrums as far as real economy is concerned into sort of relatively buoyant condition, markets sort of have this conundrum whether markets and economies would be able to adjust to these high real rates. So that's the phase we are in right now. I know it's a little bit complex for a regular investor, but I guess as I've said many times on your show, that we continue to watch macro. Inflation as such is not very bad. If interest rates continue to rise, it's okay, but they will induce some volatility in equity markets, and which is what is playing out in front of us in the last few days.
Okay, give us a sense as to where you stand when it comes to the overall PEs and how you're looking at the markets from a valuation standpoint. Do you believe that as of now, as you had said in the past, that a lot of bottom-up investors are currently looking at those ratios, and from a historical point, they believe it's expensive? Where do you stand on the overall valuation point?
No, I mean, I've argued many times, valuations are, at least, especially when you are coming out of such a traumatic experience that we've had over the last 8-10 months, valuations, are somewhat backward looking and of course expensive. It's just that, you have to look forward, and it's very likely that, they will, most of these matrices, price to book or price to equity particularly, will begin to look reasonable. And you've seen many reports, from bottom-up investors and, sell sides arguing now that, look, the earnings are likely to get upgraded quite sharply. And therefore, a lot of these valuation matrices, will begin to look reasonable. And I still think that markets will do very well over the long term. As I said, so I do not buy this point that the valuations are expensive, or rather, I mean, at least I don't buy this point. I've argued against the very idea that people perpetuate that it's a bubbly market. They are somewhat expensive right now because we are coming out of a painful period of last 8-10 months of economic destruction. But, things are looking up. Most people on your show, most firms are actually guiding for very good sort of sales and profit outcome over the next couple of quarters. And I think, they will sort of rebalance lower, and, valuations would actually start to look fairly okay. So Again, don't look at the window of valuation from the point of view of today's correction and the correction which might play out over the next couple of weeks. It's a macro correction playing out. Please understand, and maybe it's important to convey to investors that it's not a correction of high valuations and bubbly valuations, and markets are getting unwind. It's a correction of a macro where people are big spooked today that interest rates and real rates are rising, but the central bankers are not putting out fires right now. But very soon, I think at some point in time in next 1-2 months, at some level of US Treasury bonds or Indian bonds, central bankers would come and douse fire, and perhaps that is when a macro condition for dialing this again would emerge.
First, is there a tactical way of approaching a high inflationary environment? I mean, would you want to stay away then from rate sensitives? What we're seeing right now is a massive cool-off across the board, but it's banks which are taking the sharpest knock. Or would you say that that's not the most prudent way because, in the cyclical recovery, banks also are going to do well, given that they were the last ones to actually rise up in the post-budget move?
Yeah, so you're absolutely right that it's a rate-led sell-off, and what does rate hurt the most is the growth. Stocks like, just think of stocks like Tesla or Nikola or and tech. These are growth stocks, and therefore by virtue of being growth stocks, high duration, okay, and therefore become extremely rate sensitive. Whereas the other part of stuff in the stock markets, which almost everyone hates in last few years, is the value stocks. And by virtue of being value, they're actually low duration stocks, and therefore may actually benefit from the current commodity reflation and economic traction. So for outright equity investors or a compulsive equity investors, it perhaps is a time to reorient portfolios in favor of value versus growth. But you're right that rate sensitives would actually worsen. But then, remember that banks are different. For banks, real economy matters, and real rates, are not necessarily bad for banks, and steep yield curves are not bad for banks. So all of these conditions are actually good for banks, and therefore it is true that today they may be correcting. I don't track markets, R to R, but in general, value, including rate sensitives, would including banks, would perhaps do okay over the next couple of months, because these conditions are actually fairly sanguine for banks.
Catch-22 situation actually, because the other rate sensitives as well, Maneesh, likely your autos, real estate, the traditional ones I'm talking about, that's also a segment where you have growth kicking in. I mean, be it real estate, on the way residential market is actually seeing bookings after bookings, or for that matter, the way the monthly auto sales data, which is now no more restricted to only rural tractor sales, but you're seeing it across the board recovery, passenger vehicles, commercial vehicles, what have you.
Yeah, so again, growth is good, okay? And all the time, good growth is not good for stocks. And different growth conditions mean different things for different stocks, okay? At least from a macro narrative standpoint. High growth stocks typically tend to get valued at, at least in the last couple of years in low inflation, in deflation environment, they tend to get valued at higher multiples. But then they also become extremely rate sensitive, particularly real rates. Again, I want to emphasize this. There is a little bit of an adjustment happening right now. Again, don't get this wrong that, this would also mean lower commodity prices, because it is possible that good economic traction would continue to mean that commodity prices, continue to stay elevated. So in a sense, there's some correction that's playing out in equity markets today is shall I say, a little bit of a bull market correction. I hate this term, but it's a bull market correction because it's happening in sort of a very benign economic environment where economy is gaining traction, and it's an adjustment of real rates which is playing out which perhaps would actually not last for long, because in the end, if the real economy is going to do well, we've all learned over the last couple of decades that, good economy is good for stocks. So it would sort of do reasonably well and would mean, good for stocks in long term. So some of the auto stocks, some of the firms, whose cash flows are out there in future, okay, and all of that was getting priced at elevated price to earning levels, they are, because, they are growth stocks, become extremely sensitive to real rates, and which is why sort of a little bit of shock treatment there, because market has moved. Now, how much real rates have moved? Frankly, it's not very high, okay? On an average for last 5 years, 10 years, US real rates, let's say, have been somewhere between 35 to 50 basis points. Right now, they're just 5 basis points, so they're very low, but they're coming from minus 1% few months ago. So, but all this while it was fine, but right now, just markets are beginning to sort of little get spooky about this, that what if they rise to 50, 100 basis point? What if Fed does not come and put out fire? And so, which is why these concerns, and which is why, some nasty corrections playing out. But I mean, again, go back to the basic theme. In the end, if economy does well, all sorts of stocks will continue to do very well over long term.
Sure, I get your point. Also, Maneesh, I'm not even sure if it's fair to ask you, but how much of a correction would the market try and digest in this event of the bond yield shake-off? I mean, we've already risen, 10% on the Nifty in just the last series, that's the month of February, and 20% on the Nifty Bank. How much could we actually correct from here? Because in the last week's correction up until Monday, we've already fallen about 5% from the post-budget rally.
I mean, you know more than me actually that, bull markets, we tend to have these regular 5, 10, 20% corrections over and over again. So, I have no particular number in my mind, and nor does it actually bother me. But yeah, it's a broader thesis, and that, broadly things will be fine. But in near term, for a variety of reasons, markets find their way to correct, and, it's happening. How much? I frankly don't know. But again, I just want to make this point here that don't confuse this as an expression of bubble going bust, because the arguments of bubble is outright wrong. Why markets are correcting today is the logic or the reason of is opposite of, people like Jeremy Grantham and many others have talked about, which is that it's a bubble and it's going to go bust. Okay? It is correcting because economy seems to doing very well and rates are actually rising. Rates are rising, and Fed and many other central bankers are tolerating it because even they are of the view, it seems, that economy is recovering very well. So it's just the opposite of many people who think that or pessimistic people who think that it's outright bad and economy will not recover and stocks are there frothy and sky high valuations and will correct. No, the reasons are very different, and reasons are to do with strong economy means higher rates means some adjustment, which most probably is a temporary one. How much, ma'am, I really don't know and can't answer. But it wouldn't be, bubble's definition, of course, is, 30, 40, 50% correction. And I've argued against this many times that nothing of that sort is going to happen. Perhaps, this is a good time for a lot of investors, particularly my friends and Indians, if there is a reasonable correction, it's time that this begin to come back to us and to mutual funds and, dial risk, because foreigners have been buying India all along and Indians have missed out. So it's an opportunity for them to dial risk in India.
I'm tempted to ask you one more question, although I must admit that I liked how you said it in one breath, 5, 10, 20%. But okay, what would you be tempted to buy in the fall, Maneesh? Because what started with just an IT, pharma and Reliance Industries kind of a recovery from the March lows has spread its wings now all the way up to PSUs, which is sort of the last in the baton to be holding up.
Don't call PSUs the last one, it's a durable one. And again, it's a different matter altogether, but, absolutely delighted to see what our government is doing, and I'm not backing for government, of course, but, the whole spin-off on privatization and and government willing to exit businesses that they've nurtured over the last 50, 70 years. It's such a good news, and I've argued with my investors many times. It's a bit of a Thatcher moment sort of in front of us, and it seems this government's very, very committed to exit PSU. So, I mean, I know, in a popular culture, it would be there'll be a narrative that PSUs were the last bit. I think there are going to be legs there because PSUs tend to be both value as well as because there are going to be ownership reforms. I think they're going to gain traction, and I think I would advise investors to come in our PSU fund or any of these PSU funds. I think they're going to do very well. Don't make this a part of a narrative that it started with something and look it has ended with PSUs or real estate. It's not ended. These are sort of part of any bull market or any market that sort of does have these retracements, and you've been here in the market for so long, you tend to have 5, 10%, 15% correction. Again, last 10 years, if you look at Nifty or in the first 10 years of Naughties, you see, Nifty did correct, 10, 20% many times, and yet, investors made phenomenal money by staying invested. So I guess stay invested and use this opportunity to sort of dial risk if you miss this.
Okay, Maneesh, great to have you on the show and really, put things into perspective for us as well as our viewers. Good speaking with you.
Right.
Thanks. Okay, that's Maneesh Dangi making sense of why this steep fall in the markets. By the way, we are now around 4% on the Nifty. 14,571 is where we're currently at. It's a 604 point fall that you're seeing on the Nifty futures.